purpose of the conference is to examine advances in the analysis of hedge fund strategies, and we've been doing that for 10 years now. So a hedge fund is an alternative investment fund that is more flexible in the way that it can execute its strategies but also remunerates its fund managers. That allows them to potentially explore opportunities that are not available to traditional investment funds. There may be a worry in this popular discussion about hedge funds given that they are complex and therefore may be poorly understood. But when one looks at the details, one first needs to recognize that they're very different, and it's hard to generalize about the industry or funds in general. There is another example of the potential risk, which is that as the industry grows and as fund grows, they face the same capacity constraints as mutual funds. In a sense, one's perception of the industry also has to evolve, and the industry is constantly evolving. When I started the conference 10 years ago, I chose the title to communicate what the conference is about, and the title is Advances in the Analysis of Hedge Fund Strategies. And to me that has two main components. One is about the industrial organization of the industry that has relevance for how the industry and how the funds are performing, and the relevance for regulators and investors of the industry. What is optimal to one fund may not be optimal when one looks at aggregate behavior. The second aspect of the conference is related to the strategies, and one can classify them based on asset class, for example, or trading strategy. And over the last 10 years, within each asset class, we try to keep up with the latest developments and the latest issues and contribute to this discussion. There are several papers that try to understand capacity constraints at the fund level, but also at the industry level. And that is related to research that we have, for example, done on how investors have to adapt their return expectations given constraints related to, for example, fund size and other constraints. So capacity constraints can be defined in different ways, so one has to be very specific. The way that one of the papers in the conference defines it today is to look at fund size, how, for example, the relationship between how much a fund turns over its portfolio affects its performance. I think a key takeaway from the conference is that one needs to be very precise in the way how one thinks about performance. For example, skill and performance are not just captured by the average risk-adjusted performance. It also matters to ask how large a given fund is. So a fund that manages, say, only 100 million and has a performance of 3% risk-adjusted is not the same skill as a fund that would have, say, 2 billion or 20 billion. The other important takeaways is to incorporate transaction costs and liquidity to the evaluation of trading strategies.